Hey, good. What's up? I think you're on mute. I can't hear you.
Right. Yeah, it's nice if we can have a little conversation of, I think we should just focus a bit on some small caps listed in South Africa. I know you also do a lot of research regarding small caps and shares on the JSE, and you also share some cool content. So I thought we can just talk about everything going on and our favorite small caps, why we like them, and what we see going forward. So what are your favorite? Let's kick off with that. What are your favorite 3 small caps listed on the JSE?
Sure. Okay. Tricky one. But I can give you an answer. They are not exactly small caps. They're more like mid caps. But if you ask me my 3 favorite mid to small caps on the JSE, I'd say Afrimat is one of them. I'd say Discovery is another, although Discovery, I wouldn't necessarily even call it a mid cap. It's more of a large cap, but I'm being cheeky pushing it in there. And then I would say Bellwin Properties is great, but I'm going to pick Transaction Capital for this one.
Okay,
so
cool.
Afrimat, Discovery, and Transaction Capital. What about
you?
you?
Transaction Capital busy with We Buy Cars acquisition. Has that gone through yet or not?
It has, yeah. So they finished up with that acquisition, got about 50% or 49.9% of We Buy Cars. I think it's only 5% of their market cap though. But to be honest, man, I mean, I wish I could show you the figures. In fact, I probably can, because this is going to be recorded for YouTube. Hey.
Yes.
Yeah. So then I can share my screen and show you the figures. But it's wild. I mean, you must see if you look at the figures of We Buy Cars and you compare it to international peers relative to others, We Buy Cars was got at like a super cheap price. Let me see if I can put it up for you here.
Yeah, I don't know. I mean, in South Africa, even We Buy Cars is doing great. And usually when you see a certain industry and they get a lot of competition, that's when you know, like, that business actually doing well, because other new entrants won't, enter the market as well if the market is a bad market. And I mean, We Buy Cars is massive. You just see them promote everywhere, and people have to sell and buy cars. So it's a great business. And I've also been following Transaction Capital for years, and they've got a great management. They're doing phenomenal things with the taxi industry, but also with their credit services. I don't know too much about that, but yeah, over to you.
Have you seen this?
I haven't seen this. This will be actually very interesting.
So this is a comparison between We Buy Cars, Vroom, Kavana, and CarMax, each of which are international competitors. You can see here, if you look at the growth rate from We Buy Cars, it's second only to Carvana. This actually, I'm looking at this graphic, it doesn't show exactly what I wanted to show you. But if you look at the profitability, We Buy Cars, I think of the 3 is the only one that's actually profitable. That is largely because the other 3 are reinvesting at the moment in growth. I do think there's a lot of room for We Buy Cars to grow. I hope that they continue to reinvest as aggressively as the others. From my side, look, they really don't need to be turning a profit at this point. I expect that Transaction Capital I don't think they will want to put more money in, but they are happy to break even. And so as long as We Buy Cars is breaking even, they can invest as rapidly as possible. Because it's all about a growth game in this instance.
This is very interesting, especially if you look at Carvana's share price in the US. It's just growing phenomenally. So compared to that's another thing, from South Africa's small caps and even medium caps. If you look at the US, their small caps growing at 30, 50, 70% year on year. They're trading at price to sales ratios of 20, 25, 30. Well, if you look at companies in South Africa, which comes to my 3 favorite picks, which is like Santova, Master Drilling, and then there's a few others that I could say third place. Alaris is one of them. Alaris or Alaris, I don't know how you say that. Even Adapt IT. But so many of our small caps they're growing revenues, growing profits, expanding market share, but the share price is just staying stagnant. And if those companies were to be listed in the US, imagine just like how things would have been different with all their retail investors just pouring money into the US markets. And that's a problem we have in South Africa. Why these small caps give a great performance.
Well, you know what, hey, I heard someone say the other day, and it kind of stuck with me, but it's not an apples to apples comparison when you have the States and the US. I mean, the States and South Africa. It's the same as if you go and buy a property. You know, you could buy like a 5-bedroom house in the middle of Sandton. That'll cost you a fortune. You can buy a 5-bedroom house in the middle of the Karoo, and that'll be like not even a tenth of the price, you know. So the location is actually very important. And I do think like there's the access to capital, the political risk. There's a reason why a lot of these South African companies are very cheap. I also think that the comparison that you're making, and I definitely understand where it's coming from, but if you look at like South African tech distributors in South Africa, they are not the same tech companies as tech companies in the States. The business models are just fundamentally different. So even the three that you picked, I would say Alaris, yeah, for sure. Alaris would probably trade quite a better multiple, maybe double the multiple it is currently at. But Santova, I don't know. Santova is an interesting one. What are they fundamentally? They're a tech-enabled debtors book, right? Like their primary model, they will punt themselves as a, and I'm long Santova, so I'm bullish on them, but they will punt themselves as a tech-enabled platform, whereas in reality, it's a little bit more of a 3PL logistics player that facilitates the debtors book. So I don't know about if Santova would trade that much more expensive. What do you think?
Well, it's definitely. I think there is more to that than just a debtors book. But for me, it's more just comparing revenue straight on. So Santova it's quite complex. I don't know the business inside out. But if I strictly look at the financials, they're growing revenues, they're growing profits, they're growing net asset value, and they are a global business. They've got operations globally. So that's part of the geographic components of where you listed. So on the JSE, your entire business can be global, but at the end of the day, you live in South Africa. So if there's not enough investors in South Africa, that will affect your share price, even though your business is doing great. So I think it's more where you listed than where you're operating. If you look at the small caps, because I know there's a few small caps, Master Drilling, they even report in dollars. So they also got global operations, but they're listed in South Africa. And I've spoken to a few other people as well saying they can't understand why some of our companies are so low. And it's basically just that reason. We don't have, people are just moving their money offshore because of the political risks and everything, which is quite bad for our small caps, and raising capital and allocating cash. It's tricky.
It is a tricky one because, I mean, like you said, in a lot of the instances, the thesis that you've seen has been there for the last 5 years, 4 years, and the share price has gone nowhere. Santova is a case in point, but MDI is also one. I think they haven't really moved much despite the increase. Bola Metcalf, all of these guys, they are really great companies and they're just stupidly cheap. But I don't know. For me, I do think that there is a fundamental shift in the way that people are appraising business models. And unfortunately, South African small caps don't really hit those. I mean, there's very few that do, but don't really hit those kind of business model appraisals. I do think what's interesting is you do see some small caps like Cartrack and Montauk. I think it's pronounced Montauk.
Cartrack is doing very well.
Yeah, Cartrack and Montauk, where as soon as they announce the listing offshore, you see a tripling in maybe not a tripling, but a doubling in the trading multiple, So I do think that there's definitely value there.
Over the next few years, we're probably going to see many delistings or acquisitions from private investors or other public companies with each other, like that huge group trying to acquire Adapt IT. I think we're going to see many of these with good companies being undervalued. But I want to get your opinion on on two small caps that's been really trending in the news. The one, I don't know if you're going to know, but the other one you probably know. So the first is Purple Group, who owns EasyEquities.
Yes.
And then the second one is Nutritional Holding, trading at
Trading at what? Sorry, what was that last part about nutritional holding?
one share.
Sorry, man, you're breaking up. I can't hear properly.
1 cent a share.
1 cent a share, hectic. Okay, so I've never looked into nutritional holdings, but I remember the one. I'll start with nutritional holdings because it's the one I know the least about, and then I'll dive into PPE just now. But so that whole 1 cent a share thing was the same reason why a lot of people were bullish on Aving a while back, where its price would fluctuate between like 1 and 2 cents per share, and sometimes up to 3, sometimes up to 4, but almost like every second day it would drop again. And the idea is being that, like, look, if you buy it at 1 cent a share, then there's literally nowhere the price can go. That's rock bottom. So it's a price action bet more than it is like a fundamental bet on the company. I think.
The thing is, to quickly interrupt you with a fundamental. So they're shifting the business model a lot, and they're moving into the cannabis industry. They're putting their focus in the cannabis industry. And they've actually now reported, with the previous earnings, they reported their first profit. I don't know if it was the first, but they reported a profit compared to a loss in the previous period. And they also showed a triple-figure revenue growth. I can't remember the exact figure, but the revenues grew triple figures, profits grew triple figures. So it's maybe this cannabis thing can play off. And if you look at the cannabis shares in the US, they're just skyrocketing.
Yeah, if I'm honest, I think that the cannabis is just a little bit of a hype thing. You look back in 2017, there was the same talk around cannabis stocks. It skyrockets, dips, plateaus. It's kind of like there's a lot of these companies where you can build hype around, or industries, Bitcoin, again, long Bitcoin, but there's these things where you can build a lot of hype around them just because they have that like meme ability. But I think that we have yet to see some very serious traction in that space. Again, I'm speaking a bit out of ignorance. So I've never looked into nutritional holdings. I've never looked into cannabis stocks like exclusively. So I am speaking with under a lot of correction here.
Okay, cool. Let's have a look at Purple Group. What do you think?
Hey, I'm bullish. I really like them, man. I think firstly, Charles Savage is fantastic. I think that as a shareholder, he ticks the visionary box. He ticks the stakeholder engagement box. He's probably the most active shareholder that I've seen from any of the companies in the JSE. And he's very engaging, friendly guy. I love the vision of the company. I think that like the whole democratization of finance thing is brilliant. And I know it's, so I've used EasyEquities a bit. I've also used a couple of the other brokerages and some brokerages offshore. And EasyEquities is really fantastic. Just the UI, UX is brilliant. So as a product, I would say it's good. I also think that it's quite innovative and it's pretty disruptive as far as, so the thesis is that like, if a company is to be qualified as disruptive, it's got to be 10 times better than the competitors in order to disrupt the industry. And I would say that EasyEquities and Easy Properties especially are 10 times better than the closest brokerage competitor. The reason for that is their targeting of the retail market as a brand positioning thing, and the fractional share capacity, which I think is patented, but I'm not sure, are both brilliant products. Easy Properties especially is good.
Yeah, I know they're growing like more than 2,000 users a day. Not all of them are active, but they're growing a lot. And it's definitely, if everything just goes on like it's going on now for the next few years, it's going to be a great investment. But there's two risks that I'm just playing with. I'm also very bullish on Purple Group. I have a lot of Purple Group shares, but the two risks are, first of all, regulatory risks. So there's, because each year or every second year, I'm not too familiar, I'm not a lawyer, but I know there's certain licenses that you have to get every year or every now and then, maybe every 4 years. Like I said, I'm not too sure, but the one risk is that regulation may affect them, especially with what we've seen with GameStop and the power shifting to the retail investors. And imagine you are the government or these hedge funds with the power, and you see you losing your power. You're obviously going to try and step in. So I'm just regulation. You never know with a company that has to do with licenses and regulation. That is a risk to consider. And the second one that comes to mind is most of the EasyEquities users, most of the Robinhood, most of eToro, all these platforms, most of these people has never ever seen a bear market or a true market crash. We had last year's March crash, but then all of a sudden it was just hitting new all-time highs again. And there will come another bear market or another stock market crash. It's impossible for markets to just go on like it's going on now in this bull market. And I'm just wondering how that would affect the state of mind from all these retail investors when they say, oh no, I'm losing, and then, okay, no, this is gambling, I'm closing my account or withdrawing.
Yeah.
How they will the management.
Yeah, no, 100%. I'm completely with you there. I think that for me, the biggest risk is the fact that Oaks did join during like a massive bull market. And now, because every asset has been in like a lovely ride upwards for the last 12, 15 months, barring COVID, everybody feels like this is the norm, right? And I think that I don't know what the stomach of the retail is like. So it's possible that in the next downturn, everybody's like, hectic, no, I'm out. And that for me is a big risk. It's one of the reasons why I think something like Robinhood is probably not the best because of the gamification aspects. So while I think that it's a good idea to make something easily accessible and like bring people in, teach people about stuff, it's good. I think that the problem is where you start to treat it like extremely lighthearted, and it becomes too easy, which is why I like the fact that EasyEquities is not commission free. I think that their model it lends itself a little bit more seriously towards like, okay, this is not a game. Even just in the UX, it's a conscious choice to make that decision.
But
I think that,
on that, so EasyEquities, they are charging commission, which is a sort of a filter. But one thing that's scary a little bit, and that's also what FinMeUp is trying to protect and save and educate people, is that I've been following some of the groups and the chats going on social media with EasyEquities users, and the way some people are climbing on certain shares is just not, and they're funny. Then I
not
see
healthy.
the comment. It's gambling, if you there's a big difference between investing and just throwing money because you heard about it, or throwing money because it's weed stocks, or throwing money because it's and I'm afraid of that, because a lot of people are also losing money, making money now, but that can really go wrong if you don't understand why you're buying something, and especially with these new investors, it's just a boom market, so you're just throwing money that could really turn very fast, and I'm careful for that, for Purple Group's part, but also for the part.
Yeah, no, I'm 100% with you. I got to ask you then. So you, I've seen, have been a bit bullish on Sea Limited, and wonderful company, big fan of them. But you've been bullish on them since like 2019 end, I think. So long time, way before the current share price. To me, I've seen sentiment around that company change quite a bit. There was the original period where not many people knew about it, and it was just like this very undervalued relative to its prospects. Then there was this huge boom where it was like it was everywhere, and everybody was speaking about it. So in your analysis of Sea Limited and these kind of like notoriously bubble sentiment driven companies, what's your approach? Hyper growth companies.
So I do believe there is you should not just have fully high growth companies in your portfolio. For me, a company like Google, which can be classified as high growth, but it's not a risky high growth company. I mean, it goes, it's 15-20% year on year, but I mean, look at the revenues, the cash generation, it's just crazy. Like YouTube, it's insane. But for a company like Sea, so the way I look at Sea is, first of all, I do believe there's a lot of potential in Southeast Asia. It's part of these emerging markets, and I do believe there's a massive opportunity there. And then there's three aspects I like in investing, which is fintech. I love fintech. I love Square. I love PayPal. I love Visa, MasterCard. Everything fintech I love. They have that. It's called C-Money. Then they have e-commerce, which is, it's the future. Everybody's shopping online, and everything was just completely transformed last year to a digital world. They have that. They have shopping, which is, if you look at the app figures of downloads and the amount of new users, it's just insane. They're dominating the entire Southeast Asia, especially Indonesia. And then thirdly is gaming. The gaming industry is booming. They have Garena, which is also performing insane. So they have three aspects that are set for future expansion. And this team is extremely ambitious. They still have a lot of equity. They are the founders. They have a vision for it. And I mean, Garena is even doing well in America, and they classified as a Southeast Asia company. So it's that aspect that I like about the industry. They're growing rapidly, so it's very difficult to give an actual valuation if you're growing at those figures that they're growing at. But
yeah,
I know it's still valuable.
It is tricky. Well,
But
that's the thing, right? This is my problem also with the company like Purple Group, and you see it with companies like JD.com. JD a little bit less so because it's a little bit more established now. Meriton, even Tesla to an extent, but I'm hesitant because I don't even want to mention Tesla. But like a lot of these companies that are unprofitable because they're reinvesting in growth, for a long time the market hasn't valued them properly. And this is, I mean, you can look back at this historically, like they've just been really undervalued relative to the. So sorry, I'm going to just diverge a little bit here. But if you look at them from a DCF perspective, it makes zero sense. Whereas if you look at them from a you kind of estimate what's the TAM, and then you say of the TAM, how much can they capture? If they capture X, what's the optionality baked in? What do their steady state look like? This kind of analysis.
Just quickly for all the users, TAM is for total addressable market. So
and DCF is a discounted cash flow. Yeah. So if you do that latter analysis, then you can get to these quite like impressive valuations for this company. And people previously to, I would say, 2019 end, were valuing them with like a regular discount cash flow. My question is, this comes with a lot of baggage in itself. It's not a perfect foolproof method of valuation because you can way overhype something. And this is where I'm a little bit struggling at the moment with the valuations of these companies that have been valued like this. And so arguably you can justify the valuations, but this justification requires growth at like 60-70% per year. And C's there a little bit for me. I love the company, brilliant business model, but it's just extremely valuable.
They're growing triple figures year on year. So the thing is, what I think the change or the shift was in the US markets, why it's been such a big bull run, is the fact that people are now evaluating companies today on what the revenues are going to be in 5 years or in 10 years or in no longer in the next 3 years or, what's it valued at now, but rather what's the revenues going to be 5 years. And that's also why we see this price to sales ratio, but the companies are growing. And then, so look at Tesla. So their revenue, their entire footprint grew massively in 2020. They showed profits, they grew all of that. But that led to the share price increasing a lot. Because the share price increased, they were able to raise a lot of cash. Because people are just like throwing money at them. Because they could now raise cash, they could now reinvest that cash for that growth to actually happen. So it's like just a thing that keeps on going between the investors and the company itself, which can be dangerous. It can be very dangerous. But that's also why I think we've been seeing these massive, first of all, revenue increases, especially with the digital movement. I don't think we're going to see another year like we've seen the past 8 months. It's just one very happening, and I don't know if we're going to see all these technology companies that grew these revenues by so much last year and this year, if it's going to continue, because now all of a sudden you've got loads of offline users turning online, but now they're online. So how are you going to leverage that to even increase again and again and again and again. So I think that's we have to look at which companies are in our place to do that. For example, see that are back.
Yeah, I must be honest. Out of all of the companies that I've seen with valuations that are like obscene on traditional multiples, I do think C is one of the most enticing ones. Yeah, man. Like a chat. We've gone quite far from SA small caps, though.
I think what we can do is we can set up another chat in the future where we talk more on US stocks. I think our users will enjoy that a lot. We can see. I'll try to figure out a way how we can put this also on the FinMeUp app, but this will be on the FinMeUp YouTube channel. So everyone listening to this, you can subscribe for future videos like this. Have a great day and thanks for talking.